Today, it's time to regulate buy now, pay later properly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, we're soon going to get more from the Treasury as it reviews responses to its consultation on the regulation of the buy now, pay later industry in Australia. The original paper, which was open to stakeholders, feedback until the 23rd of December, was launched after the government noted some of the financial distress faced by buy now, pay later users and sought to have a look at how to regulate it and to put some guardrails around it. Buy now, pay later currently exists in several flavours, but it is able to avoid regulation other than a self-imposed code of conduct as a credit provider because providers do not charge interest on repayments. Treasury put forward three regulatory options for discussion. The first one is to strengthen the buy now, pay later industry code and to impose an affordability test. The second option requires buy now, pay later providers to obtain and maintain an Australian credit licence, plus to introduce modified responsibility lending obligations under the Credit Act. And the third would be to regulate buy now, pay later under the Credit Act with full responsible lending obligations, just like any other form of credit. Now, a number of submissions from the consumer advice sector continues to advocate for full regulation option 3 on the basis that if it quacks like a duck, it's a duck, meaning that, like it or not, buy now, pay later products are credit products and should be regulated as such. Lenders should have full responsible lending obligations. The complexity here, though, is that some consumers choose to use buy now, pay later because they're convenient and are often linked to online purchases. But we also know from our surveys that there is a concentration of buy now, pay later use among people with cash flow issues, and many of these are in broader financial distress. And more than 20% of users end up paying late fees and other charges, making the free credit anything but free. In fact, in the case of late payments, the APRA quickly turns into payday lending territory. So, buy now, pay later is actually often part of a broader constellation of wider debt, which may include multiple providers and loans. Others want weaker regulation. For example, the Commonwealth Bank of Australia, which itself has a buy now, pay later product called Step Pay, with more than 300,000 Step Pay customers, who they claim make over 1.5 million transactions per month. And they also estimate that 40% of those Australians that use buy now, pay later operate more than one account. So, CBA says it supports the government's approach to strengthening protections for buy now, pay later consumers under the Credit Act, but added that any regulatory intervention should, quote, strike a balance between ensuring Australian consumers continue to benefit from buy now, pay later while also addressing consumer harms. As such, it says it supported a model that more closely aligned with option 2, but was enhanced to also include mandatory obligations around credit reporting and tighter restrictions on credit limit increases. The bank said it had long considered buy now, pay later a form of credit and believed buy now, pay later operators should hold an Australian credit licence with general obligations covering internal and external dispute resolution, hardship provisions, compensation arrangements, fee caps, and marketing. A CBA spokesperson commented, "We believe buy now, pay later can meet consumer expectations for a safe and contemporary form of short-term credit. However, a current lack of regulatory oversight is resulting in some consumers accessing credit in ways that are problematic for them." CBA supports all buy now, pay later providers being licensed under the Credit Act with requirements to assess suitability and engage with credit bureaus. We consider this is a pragmatic approach that balances the benefits that buy now, pay later has brought customers with the need to address inadequacies in the regulatory protection currently in place. Personal lender MoneyMe has flagged that regulating buy now, pay later products would improve the accuracy of credit assessments for borrowers, levelling the playing field across lenders and buy now, pay later providers, and would close the credit reporting blind spot created by omitting Buy Now, Pay Later from the Credit Act. Speaking on the matter, MoneyMe's Chief Executive and Managing Director Clayton Howes said, "We are strong believers in responsible lending and responsible borrowing for the sake of both consumers and lenders alike. So we welcome the federal government's intention to improve consumer credit regulation, and in particular proposals that would see Buy Now, Pay Later providers subjected to the same obligations as the lenders. Accurate and extensive credit reporting allows lenders to be more accurate in our credit decisioning and in turn helps to protect consumers. The limitation of Buy Now, Pay Later data in credit reporting creates a blind spot for lenders and hinders us from getting a holistic view of a person's indebtedness and their ability to meet repayments. Some of the changes proposed by the Treasury will also level the playing field in the industry. Similar onboarding requirements to other credit products in the market would impact the ease at which consumers can access Buy Now, Pay Later, which might see consumers shift away from Buy Now, Pay Later and back to credit cards. With this advantage no longer in play, it would also make it less attractive for merchants to offer it at the point of sale, as credit card merchant fees are often a cheaper option. Now, last year, the Australian Prudential Regulatory Authority, APRA, amended its prudential framework and made it clear that banks will need to include Buy Now, Pay Later and higher education debts when reporting debt-to-income ratios. The changes aimed to ensure that banks are, quote, operationally prepared to limit growth in higher risk residential mortgage lending, such as loans at high debt-to-income multiples or high loan-to-valuation ratios. Under the changes, the DTI is now the ratio of the credit limit of all debts held by the borrower to the borrower's gross income, annual before tax verified by ADI, excluding compulsory superannuation contributions and before any discounts or haircuts under the ADI's serviceability assessment policy. Previously, lenders saw Buy Now, Pay Later facilities just as an extension of declared living expenses. Buy Now, Pay Later facilities did not show up on your comprehensive credit report, so it was a good option to utilise when you wanted to purchase larger items online and pay them off, usually over, say, 4 to 6 smaller fortnightly payments. But while it looked like an easy and convenient way to purchase items, particularly in times of cost of living increases and rising interest rates, you have to consider the impact it has on obtaining credit in the future now, as lenders are treating Buy Now, Pay Later very differently. When you start an application with a Buy Now, Pay Later facility, and even if you don't proceed or aren't approved, this is recorded on your credit score and reduces your score by, say, 50 points. And if you miss a repayment or had a conduct issue on your Buy Now, Pay Later facility, this could significantly reduce your score when applying for credit. You will have to explain the reasons behind the late payment. A lender actually could decline your application based simply on the conduct of a Buy Now, Pay Later facility. And if you were declaring, let's say, $500 a month on clothing and had a $500 debt on your Buy Now, Pay Later facility, they would not have considered the Buy Now, Pay Later facility a liability. But now, most lenders are adding it to show an ongoing liability, even if you owe nothing on it, which is reducing the amount of money you can borrow. And members of the broking industry also responded to the Buy Now, Pay Later regulation options paper, with the Mortgage and Finance Association of Australia, the MFAA, saying that it supported option 3, fully regulating the Buy Now, Pay Later market. Brokers had previously flagged grievances with Buy Now, Pay Later opacity, citing the impact on borrower credit scores that could be jeopardising their chances to secure a home loan. Now, we certainly continue to believe that Buy Now, Pay Later is a credit product and should be aligned to other credit access products, including mortgages, personal loans, and credit cards. It was a very clever ploy to get around the current legislation, and nothing less than full regulation under option 3 would leave some households highly exposed, especially at this time of financial pressure and high inflation. But of course, it's also worth thinking about the fact that the players who are wanting to push option 3 are the very players who already have an Australian credit licence and therefore are in a significantly advanced position relative to some of those other players who don't. So there is an interesting competitive dynamic playing out here. But from a consumer's perspective, as I've said before, if it quacks like a duck, it's a duck. It's a credit product. It should therefore be fully regulated under Australian credit legislation. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.